We are live. I'll just wait a few more seconds and let people trickle in before we get started. All right. Well, as people trickle in, we can kick things off. So first of all, hello everyone, and welcome to another Finimize live event. My name is Reda, your Finimize analyst over here, and I'm hosting today's event on mastering technical analysis for traders with our partner, IG Investment. Before we begin, we have a great event for you today. Just some housekeeping rules. First of all, you're going to see a poll come up on your screen. Please be sure to fill that out. Second of all, feel free to introduce yourself, say hello in the chat, say where you're tuning in from. Make sure you switch the message to all attendees. That way everyone can see it and not just the panelists. And then high level, the way this event is going to work, our guest today is going to give a roughly 20-minute presentation masterclass on technical analysis, and that will be followed by 10 minutes of Q&A. And that takes me to my final point. Please, any questions you have for our guest today, be sure to put them in the Q&A box down below in Zoom. Also, if you see a question that you like, be sure to upvote it. And that way we can go through the most upvoted questions first. So let's kick off. So as I said, our event today is with our partner, IG, and IG is the leading retail trading and investment platform. Actually, if you don't already know, IG has provided ambitious, self-directed individuals with the products, technology, and insights they need to assess opportunities in financial markets since 1974. So that's way before I was born. And if you want to learn more about technical analysis, we're going to drop a link in the chat box about IG Academy, where they have a range of interactive courses to help you develop your skills in trading. So you should see that over there. Today, we are very fortunate to have our guest, Axel Rudolph, with us. So Axel is a senior financial analyst at IG, and over the last decade has been ranked in the top 3 in the International FX Euromoney survey, winning it in 2014 and in 2019. Axel, great to have you here. How are you doing?
I'm fine, Reda. Thanks for your introduction. And I've just seen that people did the poll, and apparently, as far as I can see, I don't know whether you can see that too, 75% of you who have joined us today are bearish and 25% are bullish. And for my sins, I'm also bearish at the moment for technical reasons, and I'll tell you why later on. But let's begin with our webinar. And basically, yes, as Reda said, I work for IG. I'm a market analyst at IG, and I have been trading in the financial markets for the last 30 years, worked as a hedge fund manager, trader, and also as a technical analyst professionally for the last few decades. And today I'll just give you a very brief introduction into how you can perhaps better use technical analysis going forward and risk and money management techniques. And I'll talk to you through one simple trading strategy to begin with. So, trading strategies, well, basically, first of all, and we all know that, but a lot of people seem to be ignoring it as time goes by, all trading and investing involves risk. And you can actually control that risk. And it is you quite often and your own emotions which can negatively impact the way you trade that risk. And that's why a lot of people lose money. So first of all, what you need in order to trade successfully is obviously to have a winning trading strategy. You need to have the odds in your favor. If you play roulette, for example, in a casino, in Europe, because they have 1-0, the odds are stacked against you. The casino wins with 2.26% more on average than the punters lose. In the US, it's actually 2 zeros. They have an advantage, or an edge, as you might call it, of 5.26%. So for every $1 million that is sort of played on a casino wheel, at roulette in the US, the casino would make about $50,000 in profit. In trading, it's similar. When you trade, you have, even if you have an edge, you have the odds stacked against you because you have the spread to pay, a commission to pay, and also you have what is called slippage. as you all know, and that is when you try to enter or exit a trade at a certain level and the market moves very quickly and doesn't do it at the level you want it to, but at a worse level. So in order to basically deal with all of this, not only do you need an edge, so a winning trading strategy, which actually works, which you've either back tested or tried intuitively on a demo account or things like that, but you also need a trading plan. It's like any business that you run. Trading is a business. You wouldn't become a doctor tomorrow if you simply read a book or two on medicine. So it's the same with trading. You need to have a plan, you need to have a strategy, and then you need to follow that plan. And it's unbelievable how often I see people who have a plan who then at times don't follow a plan. But it has to do with our emotions when we get stressed, when we get excited. All these emotions can have a negative impact on how we trade. And I'm sure you all know that. So it's very important that you follow your plan at all times. And most importantly of all, that you manage your risk. And we'll get on to risk in about 10 minutes time once more. But before we do, what I would like you to do is just very quickly have a look at this. Invest your time in learning more about the financial markets, more about trading and risk, because it's really, really important. And a lot of people have a little knowledge they gained from all over the place on social media, for example, but it's not always a reputable source. So IG offers you, as Reda just said, the Trading Academy. You just click on IG.com. On the website, you have this tab here, Trading Academy, and you can basically look at course videos, webinars. You have videos of trading, risk management, money management. You have that for beginners, intermediate, and advanced traders. And also our sister company, dailyfx.com, they have something very similar. It's all for free. You don't need to sign up. They have an education tab, and you've got really good high quality information on there, which is unbiased. Also, if this has nothing to do with the IG itself, but there is the Society of Technical Analysts, which I am a member of, and I'm the head of education there. It's a not-for-profit body, basically. And they teach technical analysis courses globally, and also on money and risk management and behavioral finance subjects and things like that. And I'm just mentioning it here because they have a course which starts next October. Now, this is paying. You need to be a member of the society, whereas the content of IG is all for free for you. But maybe that is something that you might want to consider as well as a reputable source going forward, especially if you want to learn more about technical analysis per se. Now, here are just the QR codes if you want to have a look at them. I'll put them at the end of the presentation again. So for the Academy is the one on the left. For the app, if you want to look at it on your phone or on your tablet, it's in the middle, and then DailyFX, it's on the right-hand side. All of this is for free. You don't need to sign up. It's all freely available information. Now, as I said, learn as much as you can, obviously, but also get familiar with the platform, whether that is our platform or somebody else's platform. Get familiar with the platform you're trading on, because you need to make sure that when you place an order, when you place a stop loss, when you modify an order, that you can do so without incurring the risk of losing some of your hard-earned money. So you want to do it on a demo account first and foremost. And once you're familiar with the platform and really tried out different situations, pretended to trade for real with hypothetical money, and once you start to make money with your trading strategy, doing it hypothetically, only then should you trade for real. What I see quite often is that people want to, obviously they're excited, they want to start trading straight away. They do so with their money, but because they're not familiar with the platform, or they haven't really got an edge or a strategy, they end up losing very, very quickly. Or sometimes even worse, they make a lot of money very quickly, and they think they can really do it for real then with their money, and they start losing money. So try it out first on a demo account is all I can say. Here on the right-hand side is the QR code if you want to look at IG's demo account. For this, yes, you would have to sign up, but again, it's freely available to you, and you can try out all your strategies on that platform there. And on the left-hand side is the one which has nothing to do with IG, it's the Society of Technical Analysts, if you want to learn more about technical analysis in particular. But let's really start with the subject matter. So I have here a very simplistic trading strategy, which I have used a version of for the last 30 years. Now, first and foremost, I'm not giving you any trading advice whatsoever. You can see here at the bottom, this is a disclaimer. I'm not here to give you trading advice. I'm showing you a way with which you could perhaps start your trading which works in a trending market, but won't work when a market trades sideways. So the trading strategy in this case is a long strategy, meaning it's in the direction of a trend that is going up, so rising prices. So what you do with a strategy is you buy one unit, and a unit could be anything. It could be £1 per point spread betting, it could be £10 per point, it could be $100 for a share, it could be whatever it is for you. And then when you have a close above a rising moving average, then you go long. And as soon as you do so, you place your stop loss order. I always know where my stop is before I even put my trading stop on, my trading bet on, before I trade long or short. I always know where my stop is because I want to manage my risk. And as I said at the beginning of this webinar, it's all about you managing your risk, and you can actually manage that risk. You are in that position. So you place your stop loss order below the last reaction low. What is a reaction low? It's simply a low on your bar or candlestick, which is lower than the one to its left and to its right. And I'm not talking here on purpose on any time frame. So all of these strategies, or the strategy I'm showing you now, can work on any asset class, on equities, on indices, on, for example, things like FX markets, and they can work on any time frames. They can work intraday, on a 5-minute chart, on an hourly chart, on a 4-hour chart, on a daily chart, on a weekly chart. So they work on all of these time frames, and they work on all of these different asset classes, as long as you have a trending market. And with this strategy here, what we do, we exit our long trade on the second consecutive close below the moving average. What that means is 2 closes, one after the other, below the moving average. That's when you get out, unless, of course, you were stopped out beforehand with that stop we had in place. So let me just show you this graphically. Here I show you the Apple share price from the end of last year. It's a daily candlestick chart. So each of these candles shows you whether the market or the Apple share price went down. In case of the candles being red, it went down. The close was below the open. And on the green candles here, it went up. So the share price opened up, opened higher, it closed higher than it opened. So that's green. And we used a 30-day simple moving average, SMA, simple moving average. It's a very simplistic strategy. And the strategy, as I said, is you, first of all, need to have a rising moving average. So here on the left-hand side, we had closes on a daily closing basis above the moving average, but the moving average was still pointing down, and it was then flattening out. And only here at the beginning of February did we have a rising moving average just before earnings were out. So once you see the rising moving average, you go long on a daily chart closing basis in this case, because it's a daily chart, and you buy 1 unit. And then what you do straight away is you place your stop loss below the last reaction low. And that is the low where the candle's low is below the one to its left and to its right. Now, you might ask me, why didn't I place it on the very same candle I went long on? Well, basically because we haven't seen the next day yet here on the right-hand side. So we don't know yet that that's the last reaction low. But once we saw this candle here, what we could have done is basically move our stop up from that reaction low to the next higher one, to this one here. And then we let the position run, and then the Apple share price rose, and then it fell back again. And here you can see it tested the 30-day simple moving average, and it bounced off it. And then it retested it here, and it closed on it. And then we had this red candle here where we fell through it and closed below it. And then on the next green candle, even though it was a bullish day, we, for second consecutive day, closed below the moving average, thereby forcing us to exit our trade on the close on that day. So this is the strategy. And you can see here, in this case, on the Apple share price, with a strategy, even though we went into profit for a while, we actually got stopped out more or less around break even. Fine. So what do you do next? Well, you look at the moving average. Is it still rising? Yes, it is. So we still have an uptrend in place, because the moving average is just a lagging indicator of the price action itself. It is just mirroring what the price action is doing. So we have a rising moving average, and then we have this long green candle, bullish candle. And at the end of it, we close at the highest point of this Marubozu pattern, it's called, and that's where you buy 1 unit. And straight away, you place your stop loss below the last reaction low, that is here on 0.3, below the last low of that candle, which is lower than the one to its left and to its right. So now you have your stop loss in place. The share price goes up and then it comes down again. And then we have one daily close on this candle below the moving average. And then on the next day, we actually open lower, but close above the moving average. So we don't have 2 consecutive closes below the moving average, but above it. So therefore, we don't get stopped out on this trade because we haven't got 2 consecutive closes below the moving average. And here, what you could do, if you wanted to, is actually add to your winning trade. But what you don't want to do is increase your trading size by the same amount you started off with, because then it becomes top heavy. And if the market were to reverse very sharply and quickly in the opposite direction against you, you could lose a lot of money very quickly. So therefore, if you add to winning positions, I would suggest you add smaller size. So for example, in this case, you would add half a unit. So for example, if 1 unit for you would be £10 per point spread betting, in this case, it would be £5 per point spread betting and going long at that trade. Now, on the next day, we can see here we have a higher candle. Thereby, we have again our reaction low here, which is now higher than the previous one under 0.3. So what you can do is raise your stop loss for the whole position, for the 1.5 units to the last reaction low, and you do that here. And then you can see the Apple share price continue to go up, and you can see that the 30-day simple moving average very nicely stayed below the uptrend in the Apple share price. And yes, we retested it several times, but we didn't fall through it and then went back up above it, because in that case, you could have added to your position and even go along maybe 1/4 of a unit or something like that. And all of this happens until in August of this year, we had 1 negative close below the simple moving average here. And then we had earnings out. And then on the second day, we had a negative close again. So we had 2 consecutive negative closes below the moving average, which then took us out of our long position. Now, don't start trading this strategy straight away, because it only works in a very nicely defined uptrend like this one. And you may want to use a different moving average. You may want to use a different trading stop strategy, or take profit strategy, trading stop strategy. So you may want to move your take profit stop up in a different manner to this strategy here and only use the entry. You can do all kinds of things with this very simplistic strategy. But just be aware, this strategy does work, as I've just shown you, on a very nice trend. And here you could, for example, say, well, now the trend has changed. Look, my moving average is pointing down. I could go short. Yes, you could. But if you went short here when we went out of our trade, well, yes, the share price in Apple did fall further, but then we, after that, had 2 consecutive closes above the moving average. So you could have been stopped out here. But in reality, with the strategy we just discussed, the last reaction high in this case would have been our stop loss level. And you can see here that was very near our, sorry, the last reaction high was actually up here. So that was a long way away. But then as the share price continued to fall, you could have moved your stop down, for example. But quite often this strategy I just showed you doesn't really work at the beginning of a trend. It works better in the middle of a trend. That's why we also got stopped out in the beginning of this trend when I showed you, first of all, how this worked. And the same happens here on the downside. So this is just a simple way of using a moving average, which in itself is quite simple, and simple risk and money management tools in order to keep you in a position until the market shows you that it is reversing and stops you out. So let's talk about risk a bit more. You should only risk between 1% and 3% of the trading capital available to you on any given trade. And what I often see is people risking, let's say, 10%. So imagine you have £10,000 and you risk 10% per trade on your trade. That is to say, £1,000 per trade. If you get 5 of those trades in a row wrong, you've lost 50% of your capital. And that means you have basically lost half of your money. You now need to make 100% profit just to get back to where you were when you started trading. And the odds of you getting 5 trades wrong in a row, or going back to the casino example I mentioned earlier on, 5 reds in a row when you're betting on black, well, the odds of that happening out of 100 trades, 100 bets, is actually nearly 100%. So it will happen over time. And that's why you can't risk more than 1 to 3% of your overall trading capital per trade. And also, when you begin trading, I would urge you not to trade intraday, in and out on your phone whilst you're shopping and doing other things, etc., because your emotions will just take over and you will probably make a lot of incorrect decisions and trade on your gut feeling more than on your rational model or on your strategic setup that you've built. So maybe you should trade on a daily or weekly time frame instead. So that's really important to do as well. So that thereby you have a longer time frame, you have more time to react, you can react more rationally and think about things before actually pulling the trigger when trading or spread betting. And invest and trade in the direction of the underlying trend. This is really important because the trend is your friend. It's like swimming in the ocean. If you swim with the tide, it's much easier to do so than against the tide. So for that reason, trade in the direction of the trend. And the strategy I just showed you is trading in the direction of the trend, because basically what you're doing is you're trading with the moving average in the direction of the trend. And always, always, always use a stop loss order as soon as you place your buy or sell order. And the reason for that is the one time you don't, believe you me, that will be the one time where the market suddenly goes against you really badly and you can lose a lot of money, or you could be distracted or doing something else. So always have a stop loss order in place. Ideally have a guaranteed stop loss order in place where your broker will guarantee that level that you placed. And even if you have a flash crash or the market moves very fast, you don't have any slippage on this order. Now, obviously, the broker will charge you more for that order, but only if it gets triggered. So that's perhaps a good thing to do, just for money management purposes. Now, you might say to me, fine, I'm risking 1% per trade, but what happens if I have lots of trades open? Well, if you have lots of trades open, I would not risk more than 6% of your total trading capital on any given set of positions. So for example, if you have 3 different trades on at the same time, none of them should be bigger than 2%. So 3 times 2 is 6%. Or if you have 6 trades on, each one of these should be 1%. So just be aware of that. And in the example I gave you earlier with the £10,000, so if you only risk 1%, you would risk £100. If you risk 3%, you risk £300 on a single trade. And what you can do before you put that trade on, you can say to yourself, okay, where's my stop loss compared to my order that I'm placing now? And if that stop loss is less than £300 away, if I risk 3% in this example, then fine, I can take this trade with this trading size I want to trade in. If the stop loss is more than £300 away, maybe you need to reduce your trading size in order to still fit into that pattern, into that risk management pattern that you've just discussed, that we've just discussed, and that you just decided to use between 1 and 3%. And believe me, if you use between 1 and 3%, yes, you might make your profits more slowly than you would otherwise do, but at least you avoid the risk of ruin where you go bust and you blow up your trading account. Now, very quickly, let your profits run. We all know about this, but I see it again and again and again. Most retail traders actually let their losses run, so add to losing trades and just keep those losses running. And they cash in their profits very quickly because they're worried that they might go away in the future. So this is called loss aversion. You let your losses run, but you cash in your profits far too early. And you should aim to get a reward to risk ratio of 2 to 1. But even if you're right 50% of the time and get it right about 1.3 times more than you do get it wrong, you will still make money over time. It's all about the averages. So in order to increase your averages, add to winning positions. Don't ever add to losing positions. Again, that's something that a lot of people do. And I've seen traders who are right 90% of the time, which is incredible, but they still lost money overall because the 10% they got wrong, those negative trades were so big they wiped out all of their profits. And also what a lot of traders do, they place their stop losses far too close to the market. Markets change volatility all the time. And sometimes you get a little spike in volatility and you then get stopped out. And then you think, oh, I got stopped out, but my view was right. So next time around, you might not use a stop. Don't do that. Instead of doing that, reduce your trading size again. Trade smaller, but have a wider stop. If you try and tweak your trading with that, I'm pretty sure it's going to improve it. I can't guarantee it, but the odds are then more stacked in your favor. And also, this is really, really important, you need to be focused and disciplined at all times. It doesn't matter what's happening in your life. If you are distracted, then don't trade. Take a break, do something else, but don't trade. Because if you're distracted, you won't be disciplined. If you're not disciplined, you can't follow your rules, you can't follow your stop loss orders, you can't basically stick to your strategy, and over time, you will most likely lose money. And talking of errors, I write down my errors. I still make mistakes after 30 years. I'm a human being. I have all these inherent biases we all have. And what I do, though, I have my trading plan. I have my stats going back 30 years. I can look at all of them. And what I'm trying to do is get my errors to zero. And the only way I can do this is by, for example, in my case, my trading plan is basically an Excel spreadsheet. On there, I write down all my errors. And these are not losses that I make. A loss is part of trading. It's the errors I make, not, for example, moving my stop off, because I thought my strategy might not be right, things like that, or maybe moving my stop away. I don't make that error anymore, by the way, but that's another thing. If you have stop loss in place, there's a reason for it. Don't move it further away, because all that's going to happen is you're going to increase the average losses by doing that over time. So learn from your mistakes. The way to do that is by having all of your trading written down in a trading plan and follow that trading plan. And now, before we come to question and answers, here is the QR code on the left-hand side for your demo account. You can have a free demo account. You just sign up and try it out before you trade for real, is all I can say. Trading Academy again here, and the app version of the Trading Academy. I'm now ready for questions.
That was amazing, very thorough and very useful. Thank you so much, Axel. For the interest of time, I'll jump straight into our open questions. The first one coming from RK, which is, how do you determine the number of days for the moving average? For example, do you use 30-day, 20-day, 5 days? How do you determine that?
There is no formula. Basically, what I've done is I've backtested them all, and markets are volatile and they change dynamics all the time. So there is no perfect formula. You need to work it out yourself and see what works for you. I personally use the 30 period, so it'd be 30 days, 30 hours, 30 weeks, the 55, which is like the 50-day moving average, and the 100 and 200 days. So these are just additional tools to my trading.
Amazing, thank you. And then the next one comes from Alita, who's basically asking, are CFDs better suited for day trading, or can I hold the positions for days or weeks?
You can certainly hold a position for days or weeks. If you do that via spread betting, what you should do, for example, is to use, if you trade, for example, the FTSE 100, don't trade the index, but trade the futures contract, which runs out every 3 months. So you would pay a slightly bigger spread at the beginning, but then you don't pay a daily charge, etc., and you can just let your position run over several weeks and months. And with CFDs, it's similar. You can just trade. You don't have to trade intraday or short term, and quite often it makes sense to trade longer term, as I said.
Amazing. And I think we have time for one last question. I'll go for this one from David. Do you recommend starting trading in one asset class only, or trying different asset classes?
Keep it simple. So I would say one asset class, one time frame, try your strategy on a demo account, and then once you're comfortable with it, you can look at different markets. But before you trade it for real, try out your strategy on different asset classes to see whether your strategy, which works, for example, in a trending market on equities, also works on FX, because it should do if it's a profitable strategy. And then also try it on different time frames. So if you trade, for example, every hourly chart, you need to try it out on a daily chart going back in time, or a 4-hour chart, to see whether it also works on your instrument that you're interested in.
Makes perfect sense. Thank you so much. And I know we didn't have a massive amount of time for questions, but I think you more than made up for it in this super insightful presentation you gave. I found that really, really interesting, and you hammered in, I think, and what things I believe are really, really good points in terms of what separates good traders from bad traders. So thank you so much for that, Axel.
Thank you, Reda.
Thank you, everyone, for joining us. I hope also that was really informative, and as it was, for you, as it was for me. And, if you like this, we have partnered with IG for another event that's happening on the 2nd of November, and that's on mastering tools for the modern trader. So be sure to check that out. thank you everyone for joining. Axel, thank you so much, and have a great day, everyone.